Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are talking about. It's going to be commodity, wealth building, and or financial topics. I'm going to interject and sprinkle in my opinions as we go. And let's dive in here and see what people are talking about. If you want to follow me, it's at finding_finance. And if you want to join our community, it's finding-value.com. Discount code is discount. So the first one, Matt says, much debate about the death of Newcastle 6000 thermal coal. But while perhaps in short-term dangerous territory, all it has really done thus far is fall back to its favorite magic line at the pre-COVID highs of 120 per ton. So that's basically the breakout here of July 2018. That's where we're back and retesting that breakout. So we have fallen back in coal. Obviously, we're kind of pulling, well, not kind of, we are pulling back in oil. And we're hitting these critical support levels of where the breakouts occurred back before. So that's what Newcastle Coal's doing. This guy says, talking to different mortgage brokers, realtors, there's an overwhelming belief from them that mortgage rates will drop to 4 or 5% by December 2024. A housing buying frenzy will start all over again. Real estate prices will skyrocket higher once more. And this is this guy's thoughts. It seems illegal to tell potential borrowers buying now at this high rate is fine because you'll refinance next year and your house will be worth $100K more. Eventually, even at 5% interest rates, people won't be able to afford houses unless they roll out a 40, 50-year mortgage option. And 3, if there's a recession, no one will qualify for a mortgage. And I don't really agree with a lot of the stuff in his thoughts. So he doesn't have good thoughts, in my opinion. I do think that mortgage rates could drop. I don't know what they're going to drop to, especially out by December 2024. I don't think a recession is going to impact people who qualify for mortgages at all. I think the recession is going to be much like 2000, 2001. If we get a recession here, which is possible. And then the buyers, there's so many and the shortages are so big that there will be a buying frenzy if mortgage rates do drop to that level. I agree with that, but I don't know if they're going to drop to that level. The tough part that Powell is going to be in is if we get a slowdown, what is he going to do with interest rates? Because if he drops them down to 4 or 5%, and that's where mortgage rates eventually would go, we're gonna have a home buying frenzy all over again. I agree with that, and real estate prices will skyrocket again because we don't have the inventory, and now you just solved the affordability problem. So I think that's probably correct. And I think you could get a recession in the beginning of it, and that's what causes the rates to go down. I don't know about his first one there, but there's going to be a lot of people who are going to be wanting to buy if we get 4 or 5% interest rates. I mean, it's going to be a lot of buyers. Global central bank assets have already declined by almost $6 trillion from peak levels. This is a major liquidity withdrawal from financial markets, suggesting that overall stocks have significant downside potential from their current prices. And this does, to me, look like it's kind of like the Batman pattern, but I'm seeing that pattern all over the place, not just the S&P 500. It's in a bunch of different stocks. And that's probably because the global central bank assets also somewhat has that pattern. Is this divergence between the two, is that going to close? It's going to alligator close its mouth right there, potentially, where the S&P 500 could fall. If it does fall, more than likely it's from central bank, your assets declining. And I agree with that. Will that take down commodities? If we get a slowdown here, I think everything will sell off together, but that will spur a decline in interest rates. It will also spur potentially, I don't know, something from the the central bank. I don't, whatever it is. I don't know if they do more asset buying, if they do yield curve control. I don't know what the heck they're going to do. But right now, I do think that the market is probably pretty tight. We've seen a lot of sales volume come off. I understand that he's trying to control the housing market, from my opinion. And maybe the rates are a little bit too high for the housing market to sustain. All of the previous moves have been run by real estate, and there was no other stimulus, there was no other thing. So the interest rates were a function of what the real estate market could balance out at. This time around, we had a boatload of stimulus thrown in here. The stimulus mix within the real estate market boom. That combination is going to raise inflation to a higher level than what the real estate market might be able to sustain. And that's where I talk about the stimulus hangover. The stimulus hangover, the stimulus runs out because they're not doing it right now. They're in fact rolling it backwards. And I don't know if the housing market can sustain an inflation level and a lending level where interest rates are currently at, because the interest rates chased inflation, which was both real estate market driven and stimulus driven. If you take the stimulus out of it, that's the stimulus overhang that I talk about. And we could get a slowdown from that. Recession callers, and this is about Sven. He says, how can you have a recession with this running through the economy? Serious question. Total construction spending. Total construction in the United States is ripping. We're also seeing strong jobs in construction jobs. So this pullback, it's not being driven by the real estate market. And that's what makes this pullback, I think, harder to ensure that commodities either pull back or that we get a big pullback in the overall market. It's not being driven by that, but there are weaknesses in this market of smaller sectors which could slow things down. There's no denying that. And that's where it makes things really difficult in the short term to figure out where this is going to go in the short term. Longer term, commodities are going higher because we've got the real estate market that's underbuilt, and all of that underbuilt structure, when those homes get built, that will be inflationary. But what happens in the short term if the stimulus plus real estate market pushed rates to an unsustainable level where the real estate market can't sustain it by itself, and the stimulus is on top of it is what drove it there. So that's the hardest part to answer for myself, is if the inflation rate is a component of stimulus and the real estate market of lending, if you slow down the real estate market way on, you slow the volumes way back, the stimulus isn't there anymore. So you should get a slowdown in the market because of that stimulus being taken out of the market, and real estate, the loaning, slowing down. The 10-year on a log time frame, it looks like we're still in this uptrend on a log time frame. So that looks real interesting. Are we going to break to the downside, or are we going to bounce and move on up? And that's the same question that I have. Are we going to break all the way down to a lower level, or are we going to use these support zones and bounce higher? And that's really where the questions are at. My questions that I have in the market in the short term right now is the market slowing down? And it's not really slowing down. We know it's slowing down. It's how sustainable is the inflation rate with real estate lending? And if it's not sustainable, we should see this fall back and we should see a slowdown in the market. Rates are going to have to fall to a level that is more sustaining for the real estate market. And I don't know what that level is. But also, you've got a bunch of bonds being sold on the market. So all those bonds in the market also are putting upward pressure on yields. which gives us a very weird dynamic. Logan says homeowners aren't showing cash flow stress in the data for 13 years now in any big scale or form. So mortgage originations by credit score, and you can see there's a lot of really good credit. If you look back in 03, 04, 05, they really had low credit scores, way more in the below 620 range all through here. You can see a whole bunch in the 660 to 719, but over here it's dominated by much higher credit scores, 760 plus all over the place. Very few under 620. Coming back, Bloomberg record oil call volumes. So oil calls mean that they are predicting that the price of oil would go down. Generally speaking, when you get these really weird, like these huge volumes on one side or the other, they're generally wrong. It means everyone's on one side and not the other. So we'll see if these call options are wrong, and everyone's piled into them at the moment. Home buying conditions have collapsed, reaching levels seen only once since 1960. Back then, it ended in a severe economic downturn. He says this time is no different. People don't feel like buying homes. This level was seen only once. And that will have an impact on lending. It really will, but we don't have any forced sellers. So inventory is going to remain low. Prices will remain resilient. But the volumes have dropped off. And volume, loan growth or loan volume is what puts credit into the system. And that is what has slowed down. Why home prices won't crash in the next recession. This is behind a paywall. I don't know why you put it there, but we've got soybeans breaking out to the upside. That looks pretty interesting. Some of these soft commodities are looking quite strong, including wheat, corn, soybeans, cocoa. We've got Holger here. Good old Holger. Ouch. U.S. debt interest bill rockets past a cool $1 trillion a year. It's 4% of annual U.S. GDP. It has doubled in 19 months. It is equivalent to 16.3% of the entire federal budget for fiscal year 2022. That's a big move in interest payments. Eric says, unquestionably, there are signs that the global economy is cooling. The key debate is, will this have a significant enough impact to hit oil demand to tip the market into oversupply? Given higher than expected supply growth this year, mainly from Iran, as of now, using the best tools, where did it go? Best tools available to me, I can find no serious signs of demand weakness. Even with recession in the US and Europe next year and global oil demand growing by only 1 million barrels per day, global oil inventories should still fall. From what I already know, multi-year low levels. 2, do not doubt the will and intent of HRH ABS. He ran out of things. So his forecast is the decline in inventory still with a little bump up in 2024. So a little bump here, and then it continues to decline. But what I will say is, if people get worried and there isn't credit growth, that I think it will have an impact on the price of oil. I do agree with that. This acceleration is worse than even the 2008 financial crisis. Credit card defaults are rising at a rate never seen since 1991. And that is a really big move in credit card delinquencies. It is a very large move in a very short period of time. You can see that we are seeing this also in 05, 07, and then eventually in that recession there. So that's interesting. What do you mean a melt up? So Russell 2000 monthly log chart, and it's almost ready to break the paradigm shift breakout line, but we've hit this and it's popped higher. We've hit this and it's popped higher. Is this going to hit it and move and pop on higher? It's still below the 1 and 3 year moving averages. We have lots of support underneath us, and we'll see if this holds for the Russell 2000 on a monthly log chart. Uselink, he's showing a chart of palladium closing in on the same percent drop as during the great financial crisis in 2008. You can see the 73% drop, and we're almost there. We're at 70%. This could be getting close to a potential bottom. We've got a very strong support level down at maybe $800 or so. But we'll see. We'll see where palladium goes. All Things Ventured says, just about any way you slice it, Chinese iron ore inventories are at a rock bottom, despite high imports over the last couple of months. A very constructive demand setup for Cape-size dry bulk. So port iron ore inventories, look how low that is, guys. It's way off the page low. We are now back to levels not seen since 2016 in million tons. We've got days of consumption is now is only at 20, which is below the historical average of 24. Meanwhile, imports have been rather strong compared to 2022 levels and now above 2020. So we have strong imports. Inventories are still declining, and it looks pretty interesting there. Total China iron ore import volumes, you can see, are increasing and pretty high in September and August. And that's why we're seeing the iron ore prices move upward, and steel. Eric Nettle says, does this look like weak oil demand to you? And you can obviously see on the right-hand side a big move to the upside for oil demand. Tavi says, maybe this time is different, but in the past half century, every time the unemployment rate has crossed above its 24-month moving average, it marked the beginning of a significant deterioration in labor markets. Times when an unemployment rate crossed above its 24-month moving average, and you can see we've had recessions every time we've crossed above the 24-month moving average. So are we going to get a recession here? Are we going to get a pullback? And we very well could. I'm not denying that. After this pullback in potential mortgage rates or interest rates, mortgage rates, that's where the inflation will kick back on from bank lending. That's why we're seeing strength in home builders and strength in KRE, the regional banks, I think. But that doesn't mean that potential slowdown could be coming. There's a lot of data that points to a potential slowdown. Gold, no major breakout yet, but a resolution is coming. And we're right underneath the resistance potential breakout here. It says initial target $2,500, $3,000, followed by a large pullback, culminating in an enormous bull market move, 2025 to 2027. That's the gold quarterly roadmap that he's got. We've got Permian. So this is the Permian tight oil production is going south. This is July TRRC from operational activities that occurred 6 months ago. When rig counts were 38 rigs higher than now, and when drilled uncompleted wells were being deduped big time. Don't worry about 2022 decline. 2023 will be worse. Don't ignore this. This is something in the Permian HC type oil production where we could potentially start to decline. Some of these guys are watching this. We'll see if it actually gets a decline or if we continue higher. Right now, the trend is up, but people are worried that this is about to turn around. Structural underbuilding, not the Fed, broke the housing market, Fed President Kashkari says. Check out News Lambert's latest article, link below. From 1970 to 2007, the U.S. built 1.15 million single-family homes per year. From 2008 to 2022, the U.S. built 733,000 single-family homes per year. This results in roughly 5 to 6 million homes underbuilt since 2008. If you want to adjust for slowdown in population growth, you end up at about 3.5 million homes short. Overlay the lack of building with the boomer generation living in their homes longer, millennials' family formation increasing, the majority of current owners locked in with historically low interest rates, lack of skilled labor to build homes, and increases in material prices, and you end up with a structural issue that will take at least a decade to resolve. So he thinks that this structural issue will last about a decade from the underbuilding that we've got in the housing market. And I'm in the same camp. I think that this is going to last longer, and I think that perhaps we are in the mid-cycle wobble right now. And maybe people confuse 2019 and 2020 with a mid-cycle wobble, and maybe this wobble is still going. Maybe we're in it still. And maybe we get a recession or a slowdown, and we get this kind of big wobble in the middle of it, where we've got the structural underbuilding. All the things are in place where if a recession occurs, rates fall down, and then we get a big housing bull market again, potentially. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys would like. And that's what I've got for today, guys. So we'll catch you later. This is Finding Value.